Recording to the cloud. Let's get to it. This is the tax team huddle. If I'm not mistaken, it's our fifth huddle. I actually can check. Let me make sure I know which huddle this is. Yeah, I think this is our fifth huddle. This one is on chapter 7 and 8 from the Latino Tax Pro 2025 tax preparation course. This one is particularly long, but it's worth it. So I may run through the slides a little bit, but I don't want to skip over pertinent information. So anything that you need me to stop on, I will stop. Any of the tax team that's watching this, if you guys want to ask questions, you definitely can ask questions. This is one of those ones. So this is chapter 7 of the Latino Tax Pro 2025 tax preparation course, and this one is all about itemized deductions. So, with standard deductions, all you got to do is say, click, click, boom, I want the standard deductions. And you may get this much deduction. And with itemized deductions, you can get this much deductions. And if you have a client that's in the air about which type of deduction that they um, want to use, all you have to do is try to itemize deductions. And I would advise you to ask them a few questions. If they have donated something, $500 worth of stuff, $1,000 worth of stuff, if they have, it's a little more complicated type of tax preparation, then you want to use itemized deductions. And they're not hard. They're all in the same document in the software. So this reduces your taxable income by deducting eligible expenses from your AGI. Common deductions include things like medical, mortgage, interest, state taxes, and charity. So if they have some kind of mortgage interest that's above normal, if they have paid some kind of medical deductibles or something like that, then you want to use itemized deductions. It's literally cases where you want to use this, you'll get a better return. So taxpayers should maintain receipts and documents. This way, you know the amounts, the dates, and the descriptions of what they actually paid for or donated. Compared to compare itemized versus standard deductions, you can see both, and you want to use whichever one gets the best return. Don't make it rocket science, y'all. So the TCJA, or the Tax Cuts and Jobs Act, is something that Trump put in place, and they cap the state and local tax deductions at 10,000 or 5,000 if you marry, filing single. The overall AGI based deduction limits are eliminated. Um, so if Georgia's deductions drop from 17,000 to 10,000, you can already imagine what the return looked like. And this is something that Trump did because Trump just wanted to take care of his rich friends. So you should itemize if the deductions exceed standard deductions. Once again, you can see this. You can do both. Standard deductions is nothing but a click and a pop. So you want to do these itemized deductions. If they tell you they did anything outside of the ordinary, you want to try to get them the most money as possible. So you have to consider expenses like mortgage, medical care, disaster losses, and charity, as we just spoke on in the last slide. So if they are married while filing separate, if one spouse itemizes, the other must itemize too. You gotta remember that. If you have two people that are married and they're filing separately, if one itemizes, the other one has to itemize. If you are not the person doing both of these sets of taxes, then you need to ask the questions. Questions, questions, questions. Questions are the most important part of you preparing someone's taxes, because the software does most of the heavy lifting with adding, subtracting, multiplying, and all of that. You just need to ask the right questions so you know how to file the return. If an amendment by one spouse requires both, an amendment by one spouse requires both to amend and consent to assessment. So just married filing separately is a mess, and you don't get the best return. So the only way somebody should be filing separately if they're married is if they are trying to avoid some kind of responsibility from another person, or if that person don't want to give the other person their responsibility. Other than that, you want to file jointly. Head of household filers are exempt from the requirement of having to uh, amend and then consent to an assessment and all of that. If head of household itemizes, then married filing separately spouse must itemize too. So even if one of the spouses files the head of household, then the other one has to itemize the same way. Like it just has to be congruent all across the board if they are married, whether they're filing jointly or separately. Medical and dental expenses, you want to deduct diagnosis, treatments, any disease prevention expenses. Cosmetic procedures are generally not deductible. There are a few exceptions if there are deformities, some kind of trauma injuries, or some disfiguring diseases, and they have to go get surgery to get back to normal in some kind of way, then those may be deductible. Only doctor prescribed medications are deductible, so anything over the counter is not deductible. You can deduct expenses exceeding 7.5% of AGI, and the 2024 mileage rate is 21 cents a mile. Spousal medical expenses. So if you have a spouse and you have the medical expenses and you are married, then you can itemize based on those medical expenses. Um, if you have separate returns, you need to claim only your own expenses unless you are in a community property state. And you can look this up. I believe Michigan is a community property state. In community property states, you need to divide expenses equally if paid from community funds. So if they have a joint bank account, then you can divide the expenses equally. It is no need to claim exemption for dependent if medical expenses were paid. You don't have to claim this exemption because this is a part of you taking care of this dependent. So, dependent medical expenses. You should claim expenses for a dependent if the treatment occurred while they were a dependent. Dependents must meet the criteria of child relative U.S. citizen, and their income must be below $4,700. Medical expenses can be claimed for dependents even if exemption is not claimed. So you can claim it if even if so you can put it in expenses. You don't it doesn't have to be an exemption. Um the expense eligibility applies even without claiming exemption. See, same difference. Medical expense reimbursement. Only expenses paid during the taxable year can be deducted. If you paid for a surgery last year and you want to deduct those expenses, maybe something happened because you got the surgery this year. That's cool, but it is not. It's when you paid it, not when the surgery actually happened or anything like that. Reimbursements reduce total medical deductions. Excess reimbursement may be taxable income. So if you had a reimbursement, let's say it was $25,000, that can be considered taxable income because even though you paid something, you were reimbursed something, and that's considered taxable income if it's of a certain amount. If the taxpayer paid the entire premium, excess reimbursement not included in gross income. So it wouldn't be your gross income, but it'd still be included as taxable income. It's a difference because you have gross income and then you have deductions and then you have your taxable income. So my kids text me about cookies, y'all. Live real life. IRC Section 105, accident and health plans. So the amounts from accident and health plans for personal injury or sicknesses are excluded from gross income. This is what I'm saying. It's certain things that are not included in gross income, but the it helps you when you get to taxable income. I was just sharing with Shay that I had gross income of about 100 some thousand, but I had so many deductions that I ended up only claiming like $47,000 or something, and that was taxable income. But that helped you get a better return, and I did all right for the return. But when I went to purchase a house, it was like, yeah, you was that was cool, but you only claiming this much income after you claim in the deductions and all the exceptions, different things. So you have to be careful with this. You need to understand if they're trying to do something in the next year, 2, 3, 4 years, and you want to make sure that the tax returns are compliant and they represent what the client really want. You don't want to just let me get you back the most money. You don't want to do that as a tax preparer. You want to follow the paperwork and you want to make sure you're setting them up for the best future that they can have. Reimbursements for medical expenses of employees, spouses, and dependents are also excluded. These are excluded from gross income. As I stated earlier, you don't have to pay taxes on it because it's not gross income. You will get a taxable income amount, and that's what you will have to pay taxes on. But employer contributions, Dez want to join. Dez need to join. We in this thing. Um, she in the band app, y'all. Let me let Dez join. So let's get Dez in here. But these accident and health plans. So you have employer contributions to these plans, and they are not included in gross income either if the plan meets IRS requirements. And I'm telling you, you get if you've never prepared a return, then you you've had these type of slips. So you'll get these slips and they'll say, form such and such, form this. You don't even need to know what the forms are for. When you get in the software, all you do is go to the form section and put it in the search bar, and you will get the information for that form. And you just need to put that information in there, and the software will make sure all of the information is included and excluded, and it gets to where it need to be at. You have to be careful at making sure that the client gives you all of these type of forms, because some people may not give you the forms like, well, I ain't think you needed that. No, I need everything. You got to let them know I need everything. It's acting crazy. Okay. So the revenue rule in 2003, 102 OTC. So this is just talking about medicines and supplements. So there are reimbursements for over the counter medicines, but they are excludable from gross income under Section 105B. This applies even when over the counter medicines are purchased without a prescription. Reimbursements for dietary supplements and vitamins are not excludable. Over the counter medicines must be for treating personal injuries or sicknesses. Section 105B doesn't require expenses to be deductible under Section 213A. FSA versus HSA. FSA is a use it or lose it account tied to the employer. So you have a certain amount of medical, um, you have a certain amount of medical treatment expense, whatever, it don't matter. But you can use it or lose it. It doesn't roll over. Where HSA is a permanent account with rollover benefits. It's like retirement funds. If you didn't use it, we're gonna put it in this fund. So the FSA funds must be spent within the plan year, where HSA funds roll over indefinitely, even if the taxpayer changes jobs or retires. So you're gonna still get access to that money. That's the difference. So Section 105 employer reimbursement plans. HRAs allow employers to reimburse employees for medical expenses tax free. Employers can reimburse Medicare premiums useful for employees preferring Medicare. Section 105 plans must comply with non-discrimination rules, avoiding favoring highly compensated employees. So this is something that's saying that if if the CEO has certain access to this, then the people under it should have access to it, within guidelines. Being a CEO, you do get certain privileges, but it's saying that these plans must comply with non-discrimination rules. So whatever that plan is, it has to comply. So if a person has a certain plan and it doesn't comply, then they won't be eligible for these type of reimbursement benefits. So these are benefits for favored employees may be taxed if the plan discriminates. So if it's something that they've deemed discriminatory, then the you can still be taxed on it. It's kind of simple. Once again, when you get these slips, you gonna know to put them in. And like my first year, I'm telling you, I was like, man, what is this? I was Googling it just to find out like what does this do, just so I, for learning. But I'm telling you, the software, like it's a little bar, search bar on your left side. All you got to do is put in form 22HC or whatever, and it's going to take you to where that form needs to be inputted. And it may give you a little information about that form. So it's kind of simple. As long as they give you all the information and you ask the right questions, because they may have gotten something during the year and they don't even realize you needed to properly prepare their taxes. So you have to ask the right questions. Self-employed individuals may deduct their own health insurance premiums differently. Employer paid health insurance premiums are excluded from employees' gross income. FICA taxes are not withheld on employers' paid premiums. This applies to coverage for employees, spouses, and dependents. Most states follow federal rules excluding premiums from taxable income. Taxes paid and property taxes. So state, local, or foreign taxes, real estate, and personal property taxes can be deducted. You need to know where to deduct these. I'm telling you, if you are confused, Google it. It will tell you which form is for what, and just make sure you put in whatever state they're from because different things apply to different states. I had somebody from Arizona my first year, and that damn near gave me hell because I was so used to doing Michigan, 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 and this person was in Arizona. They were from Michigan, but they had been in Arizona like 3 years, and the return was a little different. Even when you get to the state section, they have different codes and different deductions in different states. So you have to make sure you file the right return for the right state. Real estate taxes are deductible for all owned property, including timeshares. Property taxes can only be deducted by the property owner because that's who pays the property taxes. If you rent, you cannot deduct property taxes. Taxes paid can be deducted on Schedule A to reduce federal tax liability. SALT, state and local taxes, and IRC Section 111. So state and local taxes paid are withheld. That pay and withheld are deductible on Schedule A. You will see this. It's going to ask you exactly what you paid in state or local taxes, and these will be deductible on Schedule A. Remember, every state is different. So you may get a return from Georgia. I've done somebody in Florida, and it's just a little different when you get to the state section. So you have to be careful. IRC Section 111 includes recovery of previously deducted state and local taxes. The tax benefit rule applies to state and local tax refunds. Impact of the $10,000 SALT cap on deductions must be considered. So, real estate and personal property taxes. Real estate taxes based on assessed property value are deductible on Schedule A. Foreign property taxes are not deductible after 2017. So if you have somebody that have a home somewhere else, it is not deductible after 2017. They probably know that. If they've had it that long, then they already know they're not getting a deduction for it. Mortgage company pay real estate taxes are deductible by the taxpayer. If you have a homeowner, they can get this deduction. You have people who are renters and they want to take certain homeowner deductions, and that's totally illegal. And that homeowner is probably going to file for their own deductions and they will be penalized. It's not like you're going to go to jail, but they may have gotten a return of $6,000 and when they go to straighten it out, they may owe something. So this is something you have to be careful of. Personal property taxes imposed yearly based on value are deductible on Schedule A. Other taxes and home mortgage interest. Foreign tax credits can be claimed on Schedule 3 or as an itemized deduction. So if you put this in either or, the information will populate in the other place. So you don't have to do both. And when you get to the second spot, you'll see it. So you can do this in the itemized deduction section, or you can do this on a schedule 3. Either way, you're going to get the same information and the same numbers, but you will see it if you do one of the other ones. So if you get to a section that's already populated, just know it took it from another section in the software, like schedule 3 or schedule 2, whatever. Like the information will be populated in the 1040 or wherever else you're looking at. So there are $1 million deduction limits pre 2017 loans and 750K post 2017 loans. Home mortgage debt limits depend on when the loan was secured. Refinance loans are subject to the original loan's debt limit, so it just all depends on when they got the original loan. Part two, charity and casualty and theft losses. So with gifts to charity, so contributions to qualified domestic organizations are deductible. You need to make sure you get receipts, and they have to be a qualified 501c3 nonprofit. And what that means is they are considered, uh, the IRS has considered them a qualified organization. I recently got a 501c3 status nonprofit, and it's not that hard of a process, but it gives you certain privileges as a nonprofit, and people can donate to you and use it as a write off. If they are not 501c3, then they will not be eligible to do these write offs. Contributions to political groups, individuals, and for profit organizations are not deductible. So you have to explain that to them. They can say, well, I donated money to the Trump campaign or to this campaign. Yeah, that's not deductible. Raffle tickets or donations to church bingo games are not deductible. They are considered, they can be considered gambling expenses. The donation amount must be reduced if the taxpayers receive a benefit or a gift for a $60 donation. So let's say they get they donate $500 worth of clothes, and then they get a gift. You have to reduce that amount. And then you have to, the way you have to reduce it is, let's say it's something like a wallet. You don't know the cost of the wallet per se, but you can estimate that a wallet is $25. If it was a designer wallet, you may say it was $100, but you can Google it or whatever, and you can make a good estimate about how much a wallet like that costs. Cash donations. This includes donations by card, check, cash, payroll deduction. Deductions require a receipt or a bank record. You can use like a Zelle or some kind of receipt, but most people who donate understand this. So they usually keep this type of thing. So you make sure you just ask the right questions. Records must show the organization name, the amount, and the date. So even if it's just a paid invoice or something with a name, the amount, and the date, and that way you know what to count as a contribution. Payroll deduction records must include pledge card or statement. Pre-tax donations are not deductible. Non-cash contributions, FMV, and Form 8283. As I stated earlier, you want to deduct the fair market value for whatever you donate, if it's clothing, furniture. So you want to assess the donation, because they're not going to say you donated $500 worth of clothes. They're going to say you donated, 50 pieces of clothes. So you have to look at the receipt and say, okay, this is about $500, this is about $1,000, whatever. But you want to make sure you are making a fair market value assessment and not just how much they pay for it. They may have paid $1,000 for a suit 10 years ago. At this point, the suit's worth $200. So that's what you're going to count it as. Um, and that's just what any informed buyer would pay. Anybody that, oh, this is a nice suit. This look like, well, I'll give you $200. That's what you got to count the donation as. Non-cash donations over $500 require Form 8283. Motor vehicles need Form 1098C from the charity. They will give them that. They should have that. If they are uh, a 501c3, then they are used to doing these type of things. Single items over 5,000, they need an appraisal. So if you donate a necklace, you can't say, "Oh, I donated a $5,000 necklace and it hasn't been appraised," and you know that necklace fake and it's really a $50 necklace. So we don't want to play that. Use Section A for items or groups under 5,000. Section A also is used for publicly traded securities. Use Section B for donations over 5,000 per item. Separate separate form 8283 for each $5,000 plus donation. So this 8283, you will need, if you donated 10 different times with 5,000 or more, then you're gonna need 10 different forms. So they need to understand that. The organization must complete and sign part 4, section B. Property and trust and car expenses. So trusts cannot deduct charitable contributions unless it's a remainder trust. See IRC code section 170F13. This is probably going to tell you what a remainder trust is. Do not let these codes, don't let them like intimidate you. Just look it up. Like I'm telling you, Google is your best friend. Even if the like I'm telling you, I just put it in Google, it's gonna tell me what this code is, what it's used for. Like you don't, it's 170F13. And it's different sections. It's like 12, 11, 8. So it's a bunch of them, y'all. You got to be careful. But just that fast is the section code. It denies a charitable contribution deduction for certain contributions of interest in buildings located in registered historic districts unless the taxpayer includes a $500 filing fee. So you see, just look it up. Car expenses for charity requires detailed written records, and they'll give you that. Must log dates, organization, and mileage. Standard mileage rate is 14 cents per mile. Be careful, that can go up or down depending on the year. Record keeping for charitable contributions. The record type depends on the contribution amount and the type. We just went over that. Like if you had a car, you had to use a different form. Any donation more than 5,000, it took a different form. So this is what you gotta understand. So if you are confused, Google it, text me. Do not freestyle though, because you may leave money on the table for them. Taxpayers must document all their contributions during the tax year. This applies to cash, non-cash, and volunteer expenses. Keep written statements of any payment over $75, and you need to see Revenue Procedure 2006-50, 2006-47, RB 944. Reconstructing records after a disaster. If anything happens, they don't have a record, things happen. But you need to reconstruct this, and this helps with tax, federal aid, and insurance. You need a proof of loss. That proof of loss increases access to assistance. It's more accurate. The more accurate the records, it may lead to better future funding. This is essential both for individuals and businesses. Focus on the documentation and evidence of value. So if somebody say my house burned down, they have to reconstruct their records. Things happen. If they say um, it could be anything, we had a theft and they stole my file cabinet. You have to reconstruct these records. Tip, tips for reconstructing business records. You can request invoices from suppliers going back a whole year. You can retrieve last year's tax returns and licenses. You can look for photos or videos of the assets. If you took pictures and it was certain things in the background, or if you took pictures of it when you got it, you was stunting on social media. This is a way for you to say, yes, I did have this. Sketch property layout if no visual records exist. Use bank deposit to estimate lost income. If you bought something crazy, you probably used a card, or you got a receipt. It's some way you got some kind of record of it. Something in my eye. Like here in my eye. Figuring a casualty loss. Loss is a decrease in FMV or adjusted basis, whichever is less. So once again, FMV is the fair market value, and this just means what a reasonably educated person would pay for, not that you something you can get down on somebody for. If it's reasonable, that means somebody with knowledge of it will pay it. right? So that's what fair market value is. Adjusted basis includes original cost plus improvements or depreciation. Improvements after disaster may increase property value. Subtract any reimbursements received from the loss amount. See publications 547 and 551 for full guidance. Casualty and theft losses for income producing property. Casualty loss no longer allowed as itemized deduction after 2017. This loss applies to pre 218 returns using Form 4684. This includes K1 losses, bond premium, and pension investments. Include repayments over $3,000 and disability expenses. See publication 525 and 529. You probably won't run across something like that. Calculating loss for income producing property. Determine the loss by subtracting adjusted basis, salvage value, and reimbursements. Um, if you know the salvage value of, let's say it's a truck. So what happens is you spend $10,000 for a truck in 2020. We're going to say this has a 5 year life and you are basically um, you deducting like $2,000 a year and it has a salvage value of $2,000. So if you have a loss of this, then you can only claim $2,000 even though you paid $10,000. That's just how that works. So this applies to stolen or destroyed income producing property, like I said, with a truck or a tractor, something that you actually use to make money. Adjusted basis usually includes cost minus depreciation. The way I just explained it, so if it was a 5 years, is depreciating at $2,000. Um, let's say you paid $20,000 for it, and make the example a little better. So you pay $20,000 for it, it is depreciating at $2,000 a year, and the salvage value is $10,000 because over that 5 years you lost $10,000 in value to depreciation. That's how that works, if that makes sense. Rental losses require detailed record keeping and documentation. Calculations follow IRS guidelines for disasters. Sorry, y'all. Insurance payments for living expenses. Insurance for daily living expenses is not taxable income. This applies to damage, destruction, or access denial. It also covers taxpayer and household. So, if there are any insurance payments, so if you get an insurance payment for living expenses, then you have to treat that a certain way. He told me to consider reimbursement, not gain or loss. So that's just a reimbursement of something you lost. So you can avoid the taxes with that. See IRS code section 123 or for more information. Investment interest in form 4952. Investment interest is paid on loans used for securities or investments. This is they'll have a form for this. I actually seen a form for this. So um they you have certain things depending on where they got the money from. So you just have to you gotta pay attention to, and you gotta ask the right questions for them to answer correctly. So if they have some type of investment in something that they gain interest on, they won't know what all of these forms mean that they getting from companies or from the stock market or whatever. You have to ask the right questions. And once you ask those questions, you will know, okay, they got this from this, they got a T99, whatever, like whatever the forms call, you will know. The deduction is limited to net investment income. Passive or tax exempt interest is not included. You have to see at risk and passive loss rules for these limits. Part three, Form 2106, employee business expenses and other expenses. I thought more people would come on. Let me see what it's looking like. Hold on. Okay, Dez did make it on here. I couldn't see. I got everything blocked off but the
I've
presentation.
been on here for a little minute now.
I don't want no smoke, Dez. I'm just saying. All right. Form 2106, this is limited federal use and it's after 2017. Um, you okay. Different states allow different things, y'all. I'm telling you, it's not like rocket science. When you click on what state they are, you will see things like this. It'll say is no longer used on federal returns for most employees. And some states still allow it. So this seemed weird, but when you put in what state they're in, it'll tell you whether this is applicable to them or not. So you just got to make sure you put that in there. This only applies to specific roles. The Schedule A is used for state tax returns, blase, blase. The TCJA suspended miscellaneous itemized deductions. The TCJA, Trump did some hell of a things. So you'll get in there and kind of see what's going on. You can still use the form 2106, but it's like stipulations and limitations to it. So if you armed forces reservists, qualified performing artists, fee basis government officials, impairment related work expenses, but they must travel 100+ miles for services. So this you can still use this, but if you see like qualified performing artists, they may be on a tour or they may be, they may be paid to go 200 miles away. So you can still use Form 2106. Who cannot use Form 2106? Most employees are now excluded, as we just went over a comprehensible list of the type of employees that were included. Um, Self-employed individuals are also excluded. Unreimbursed expenses are not deductible. This affects common workplace deductions. Follow state rules for exceptions. Excuse me. I say a little. I'm kind of like a lot under the weather, but I'm thugging it. State deductions are still possible. Some states didn't follow the federal deduction changes. They said F Trump as they should. Form 2106 helps calculate state deductions used for eligible unreimbursed expenses. They must meet the ordinary and necessary tests. And once again, this is still the Form 2106. Um, you can look this up, but like you seen what kind of people this actually apply to. Once again, this is just telling you to follow the state specific instructions. This will be in the software. Like once you click on whatever state it is, you will see what is allowed and what's not allowed. Tax home and assignment. So tax home is the taxpayer's main place of business. No principal place of business means regular residence may be the tax home. Temporary assignments keep same tax home. So I have an office now. I cannot use my house and say that I'm using 30% of whatever, you use for your office is limited to like what is it like 300 square feet or something, whatever. I can't do that because I have an office now and I'm going to claim my office as a business expense. So it's not like you can get the home office space expense and get the say that the office. It's basically where you primarily do your business. So you have to be aware of that. If they primarily do business in the office, they cannot claim the home tax credit. Travel and transportation expenses, these can get tricky. But if they travel for business and away from the tax home, whatever that is, the office, whatever, if they travel for business and away from the tax home, they must be ordinary and necessary. Sleep rest required for deductible travel. So if the job sent them somewhere out of state or out of town, whatever, like transportation between locations is deductible. So anyway they got there, whatever they spent there, you can deduct that. Unreimbursed vehicle expenses may be deductible too. So entertainment expenses, these must be ordinary and necessary for business. Also, it cannot be lavish. Like you can't say we had a $30,000 party for business. Like that's not regular. That's very extravagant. This includes amusement, recreation, and diversion activities. So this could be a group party. This could be um, some kind of company function, anything like that. Club dues and memberships are not deductible. It must be directly related or associated to the business, and you know what makes sense. We all grown. Um, so business gifts, the limit is only $25 per client per year. So you only get $25 for that. This applies to direct and indirect gift giving. Gifts under $4 with logo are not deductible. Dual purpose items are treated as entertainment. So if it's like tickets to somewhere, or if it's whatever, like, or if you got um let's say you got them like some kind of back massager and whatever, and they can sit on it, and it's comfortable. Like I got a pillow behind me. That's treated as entertainment, depending on if it's dual use. Um, just different things like that. Packaged food and drinks are considered gifts. Any questions about this? Nobody got questions. Hey, I'm just running through it. Y'all got what y'all need. So let me come back and stop sharing this right quick. And we're gonna get to this second one. I'm going to look this week for when I can schedule the in person. So I may do a Saturday and Sunday, or I may do like a during the week, 6 o'clock, like afternoon, 5 to 7, something like that. Y'all can bring the shorties if y'all got the shorties. Um, Whatever it take, we'll get it done next month. Going into January, I want to make sure we do some in person. It's gonna be dope. Everybody get to meet everybody. Let me open up this Schedule C. Where's it? Boom. Schedule C is in the building. Now let me share this screen. Schedule C is not as long as that last one. Thank God I was running out of air. Let's talk about this Schedule C ski. What itemized deduction? Get on out of here. Y'all see that Schedule C ski? Boom. We live off the Schedule C. All right. Now I want to state this really clearly. Not everybody deserves a Schedule C. Not everybody should have a Schedule C. The feds know Schedule C is a cheat code. Stop cheating with Schedule C. If people have receipts, Shay does hair just like my fiance does hair. She uses Style Seat. She has everything in there. If people send cash apps, she don't have her cash app to where she don't know what clients send and what's going on. So anybody that's doing anything, they need to keep record of it. You cannot freestyle these type of things. So business entity types. The U.S. tax code recognizes various business entity types, each governed by specific rules and regulations. Different entities are subject to unique tax guidelines that determine how income and expenses are reported. Some business entities may be required to file Schedule C, E, and or F, depending on their structure and activities. So, sole proprietors. Sole proprietors just mean they do not have a LLC or anything else that separates their business liability from their personal liability. And as a business consultant and coach, I do not recommend this for anybody. You always want to at least get a LLC. It's $50. There's no reason why if you can't file it yourself, somebody might charge you more, but it's just $50 with the state if you don't mind waiting. A sole proprietorship is an individual owned business that is not separate legal entity. A sole proprietorship is minimal startup costs. Is crazy. It's like the bare minimum you can do. The owner is still personally liable. Income and expenses are reported on Schedule C, profit or loss from a business. And the owner is considered self-employed, which includes independent contractors and those in businesses for themselves. Income reporting requirements for Schedule C filers. Taxpayers must file a tax return if net self-employment earnings are $400 or more. Anybody that says they're self-employed and they haven't made $400, they are not self-employed. They are bums. Don't worry about it. This is what I'm trying to tell you. If somebody say, "Well, I did do this," and you like, "No, no, 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 no." You need proof. Do you have a website? Do you have anything that proves you are a business and that you are actually making money? If they have an LLC and an EIN, then they should have a business bank account. Independent contractors. An independent contractor works per contract with control over how work is done. You should not have a gray area between independent contracting and an employee. If a person is there consistently and they are not on their own volition, they are not, just, hey, I need you to make a website and you over there, that's a contract job. If you come in on a regular and you have different things to do every day, you are considered an employee, and don't let nobody tell you nothing different. If contractors are responsible for paying their own employment tax, and they don't usually do that. So this is something you gotta question them about. Always ask the right questions. Contractors can deduct ordinary and necessary business expenses on their tax returns. They must pay self-employment tax and make estimated tax payments regularly. So they are recommending that you do this quarterly because your tax payments you may owe $5,000. So you might want to pay 1,500 a quarter, 1,700 a quarter, so you're not in the mud come January. Schedule SE is a self-employment tax, and this is kind of basic. Self-employment taxpayers must pay the full 15.3% Social Security and Medicare tax. This is why you rarely get them type of people that that get large tax returns unless they have kids. That don't mean they owe, because you do have deductions and different things like that, but you will have something. It's hard to get out the mud if you self-employed and you don't have any dependents. This tax covers both the employee and employer portions. This go to show you what it is. Now, it's only taxable to 92.35% of your net profit, not your gross income. So if you have deductions, as I stated earlier, I had a bunch of deductions, and my gross income was, telling me, it was like 104 or something the other year. And I like basically deducted it all the way down to like 42,000 or something. That's what my net profit. It might have been like 47. I don't know. I think it was like 47. That's what my net profit was. That's what I had to pay taxes on, and that's how it works. It's just kind of simple. Half of the SS, half of the SE tax is deductible on Schedule 1, line 15. Reporting SE tax and net earnings method. So self-employment tax is reported on Schedule 2, line 4. We know this. We've done Schedule 2s, most of us, not you, Shay, but it's pretty simple. It applies to income reported on Schedule CEF and some church wages. So you may be a janitor for a church, even though the church is a nonprofit. You, as a janitor, are making a income from the church that's still profit. It's still taxable. Net earnings are figured using regular farm optional or non-farm optional methods. Um, Shade, pay close attention. If you're a farmer, you will have different taxable methods. Most taxpayers must use the regular method, multiply net earnings by 92.35%. So if your net earnings were 100,000, you got $92,350 as your net earnings that could be taxable. Each business requires a separate Schedule C to report income and expenses. Gross income receipts, Schedule C. Self-employment income is earned without an employer-employee relationship. Self-employment tax applies to all U.S. citizens or resident aliens with such income. Service-based business income is reported as gross income on Schedule C, line 7. Gross income includes amounts from 1099 miscellaneous, 1099-K, and 1099 NEC. The payer and payee are the same person in self-employment arrangements. This is common sense. If you are self-employed, you have to pay employer parts and your parts. It just is what it is. So here are a few different kinds of income. Taxpayers must report all business income unless the law specifically excludes it. Common income types include cash, checks, transfers, and credit card payments. Electronic payments from customers must be included as business income. Bartering is income and must be reported at its fair market value. So if somebody so if somebody did your hair for a service, you have to report that as the fair market value of getting that particular hairstyle. Income from third party settlement organizations. Income from payment apps and online marketplaces must be reported. Form 1099K reports payments for goods sold, services, or rentals. All such income is taxable, even if no Form 1099K is received. Meal deductions. This is right in there, y'all. You'll see this. So just pay attention to the guidelines and the information in the slide. To qualify for the deduction, the meal must not be lavish or extravagant. That doesn't mean you can't go spend $200 on a meal. That's kind of okay, especially with business meetings. But if it's $20,000, that is lavish and extravagant, and you cannot claim that. Ordinary business related meals are 50% deductible if overnight stay or sleep is required. You'll see that in there. It'll say 50% deductible, 100% deductible. It might be something else, but you'll see it in there. And it's 50% deductible if overnight stay or sleep is required. That's the difference. If they had to go out of town or stay somewhere overnight and then they spend $200 on a meal, $100 would be deductible. Deduction applies to most business related meals with clients, prospects, or employees. Meals must be food or beverage provided by a restaurant. The temporary 100% deduction for business meals and travel meals has expired. For tax year 2024, most meal deductions have reverted to their pre 2021 50% rates. Travel, mileage, and entertainment expenses. For tax year 2024, the business travel expense rate is 67 cents per mile. This is an increase from the 2023 rate, which was only 65.5 cents. For tax year 2025, the rate will increase again to 70 cents per mile. You don't need to know all of this stuff. You can guesstimate. People not keeping up with every single thing. But if they tell you that they travel back and forth to Houston, you can do some quick research and say, okay, is this much? Like you can do this. It's a little bit of work, but it'll help. It'll get a better return than junking up a Schedule C. Business travel costs like airfare, hotel, and taxis are deductible. Most entertainment costs are not deductible. I talked a little bit about this in the previous section, but the business use of home, you need to be careful because this is a pretty good deduction if they are actually using some space in their home for business. As I stated earlier, it is 300 square feet as the limit. Um, I kind of remember that a little bit. Self-employed taxpayers may use Form 8829 to claim home business deductions, and it will populate in Form Schedule C. Trust me, just if they fill it out either or, it's going to populate in the other one. Deductions depend on exclusive and regular business use of a specific home space. Home office deduction requirements. So the business space must be used exclusively and regularly as the principal place of business. So this is what I'm saying. I was using this space before and now I have an office. So this would not be a principal place of business for me. This is some secondary stuff. I am not going to file that particular deduction. It can also be a place to meet clients or a separate, unattached structure. Administrative or management of activities must be done primarily at the home. Exceptions to regular use requirement include certain daycare facilities and storage spaces used for inventory or product samples. You will see this in there. It's going to ask you, is the business a daycare? And this is why they are asking you that because there are certain exceptions about daycares. The tax professional must determine whether the office is in the home qualifies as the principal place of business. You got to ask questions. If you ask them, do you do this anywhere? Do you do business anywhere else? Yeah, well, I got an office over here or I this and that. Then they probably can't do it. So it must be used exclusively and regularly for administrative or management activities. It should be a fixed location. And where this should be where the taxpayer conducts substantial administrative or management activities. It's disqualifications based on if it's administrative or management activities that are performed elsewhere or the space is available to do so, as I talked about earlier. Simplify home office deduction. This is pretty simple. You just need to know that what the square feet are. And what I usually do is I usually look up the home if I don't know the square feet and they don't know it, and they tell me about the room and I can kind of guesstimate. I don't know every home exactly what the space is, so don't overthink this. So some more rules and limitations are the taxpayer must choose the simplified or regular method yearly. You cannot change this. Simplified deductions cannot create a net loss. Excess cannot be carried over. Actual expense methods allow carryover of unallowed expenses to future year. If you have different ways of reporting your
Uber.
income. You got cash, accrual, different things like that. Hold on, let me mute Shay. Let me go mute this. So simplify deductions. Um, they cannot create a net loss. So you got to be careful. Like if you do some quick deductions and it look like they like negative, like you should be able to go in there and handle your business. The home office must be used regularly and exclusively as the principal place of business. Changing from simplified to regular method may involve prior year expense carryovers. I just use the simplified method, y'all. That's all I'm saying, and it should not negatively affect the return. Here goes some basics about cost of goods sold. Cost of goods sold applies to businesses with inventory or products. Inventory is counted at the beginning and the end of the tax year. The beginning inventory equals prior year's ending inventory or purchases from the first year. So if 2023 ended with inventory of $25,000, then 2024 would begin with inventory of $25,000. It's just that simple. This is also not something you should be freestyling, especially with people that who you've done their taxes over another year, two, three, four. If you've done their taxes over the prior year, two, three, four, 5 years, then you should be able to use the information that is available to you for the previous tax return. If they have not used you, then you need to ask them for the previous year's tax return so everything can make sense. Purchases include finished products, raw materials, shipping costs minus personal use items. Cost of labor refers to production labor, not wages reported elsewhere. Components and inventory details. Materials and supplies used in production are charged the cost of goods sold. So if you had to buy socks for junk socks, that is the cost of goods sold. Other costs include overhead like the containers or freight or raw material or anything else. So if you need glue and boxes to put them in, like all of this stuff is cost of goods sold. Inventory includes the finished or partially finished goods and raw materials for sale. So that's the inventory, not the cost of goods sold. Inventory valuation methods vary by business type. See IRS publication 334. WOTC, or the Work Opportunity Tax Credit. This is credit for wages paid to workers from 10 targeted groups. The groups are available in IRC sections 5150. This credit reduces wage deduction and applies to regular and alternative minimum taxes. 40% of the first $6,000 wages if the employee works 400 hours or more. 25% if they work between 120 and 399 hours. Employees must work for the employer at least 120 hours to qualify for the Work Opportunity Tax Credit. Certain wages excluded are federally funded training, summer youth, outside zones, and things like that. Research credit. Eligible businesses can eligible businesses can claim research credit for qualified activities. Unused credits carry forward to the next tax year. Expenses for 2024 can be capitalized and amortized over 5 years. TPSOs and Form 1099K reporting. TPSOs is things like Cash App and things like that, whatever. They're going to give you Form 1099Ks. You need to report all income regardless of the amount. Form 1099K reports payments for goods, services, or property rented. Form 2 for 2024, TPSOs report payments over $5,000. They may report lower amounts optionally. IRS Notice 2024-85 provides transition relief for TPSO reporting in 2024 and 2025. Phase in. 2025 reports over $2,500. 2026 and later reports over $600. Penalties and exceptions. No 2024 penalties for TPSO failure to withhold backholding tax. Withhold backup withholding tax. There's no penalty for the TPSO. Penalties apply from 2025 onward for failing to withhold backup tax. Personal payments, gifts and reimbursements should not be reported on Form 1099K. Taxpayers can receive multiple 1099K forms from different platforms. Report incorrect or personal sale amounts on Schedule 1, Line 8V for 2024. Business versus personal transactions. Payments tagged as goods, services are business transactions, even if personal in nature. Payment apps default payments to personal unless designated as business or goods served. Now Cash App not playing. They made me get a whole different business account, and I hated it because I had a good cash tag that matched everything else that I had going on, and they was like, not. This is what we gonna do for you. And now I can't get the tag back. I'm telling you, it's terrible. I hate it. Even when I go here to try to redo it, they like, nope, nope, nope. And I think it's been like well over a year. I'm like, man, y'all tripping. But it's I mean, it's kind of the way that they maneuvering it. Man, I'm on here trying to figure it out if they just making me think about it. Like, dang, that I want to change this so bad. At least they up my limits. Now, payments tagged as goods and services are business transactions, even if they personal in nature. Um, you can't get around this. I know people want to, well, I'm just sending it to a family member, and that's cool. I send my kids money. But if somebody is actually paying for a service, you're not going to get around it because Cash App, like, even when I was just doing regular stuff on there, it recognized that like these look like business transactions. So don't try to be sneaky. The employee retention credit. Employers may qualify for a refundable credit of 50% of their qualified wages. Credit applies to wages paid between March 21st, 2020 and January 1st, 2022. The IRS paused this. You will probably not see this unless you are preparing a tax return from 2022, 23, maybe 24, like the beginning of 24. The maximum credit is 50%, and that's up to $10,000. They got to file Form 7200 to receive that. Benefits of good record keeping. Accurate records help monitor business progress. Records assist in preparing financial statements, classify receipts, and track deductible expenses. Support reported income and expenses on tax returns. Records provides insights to improve business success. Maintaining records. Keep tax records as required by IRS provisions. Maintain business income and deduction documents. Generally keep records for 3 years. That's the period of limitations. If you are uploading the information correctly in the software, the information is in the software, y'all. The information is in the software. If they sent you something and you update it, I'm definitely going to be checking that this year. So just make sure people are sending you their ID, social, any information that is pertinent to their tax return, and you just upload it in the software. I don't care if they email it to you, whatever. But when I go through this year and I actually check, uh, um, I'm going to check the documentation. Um, I've been doing like I've been going through some training about things like that, and I wanted y'all to get hip to just putting that information in their ID, whatever. The easiest way to do this is to send them the app. If you send them the app, then it go to that. It go to our software and the information to be in the records. Any questions? How long was this? Cheetah Shay good. Dez good.
Yeah, I'm good right now.
All right. I'm thugging it. I'm trying to
Yeah,
I
I'm
just
good too.
I done set up everything to record and can barely talk. So I just yeah, I'm over here on action. I ain't fucking with you, dude. I ain't fucking with you. Dude, you got me fucked up. I got heat.
Look, you got the setup back there. I see. Look, looking all
Uh,
professional.
okay. Okay, we put record now. Man, I don't want to be my business.